시청자 여러분 안녕하십니까? 한국경제TV 뉴욕 특파원으로 나와 있는 신인규 기자입니다. 오늘 이 시간에는 미국의 금융이론가이자 이피션트 프론티어의 설립자인 윌리엄 번스타인 씨를 모셨습니다. 투자의 네 기둥과 같은 유명 저서들은 국내에도 소개가 되어 있죠. 번스타인 씨와 함께 비이성적으로 보일 만큼 흔들려온 시장, 앞으로의 방향성과 미국 시장의 투자 심리를 파악해보는 시간 가져보겠습니다. It's an honor to be with you, Mr. Bernstein.
Pleasure to be here.
Okay. You have very interesting story. Started your career as a neurologist and made transition to be an investor and author. What drove you to make that decision?
Well, I happen to live in a country that does not have a functioning social welfare system or safety net. So I had to save for my own retirement. And I approached that subject of saving and investing for retirement the way I thought anybody with scientific training would do, which is I read the peer-reviewed literature, I read the basic texts, I collected data, and I built models. Now, this was back in the early to mid-1990s at a time when not many people were doing that, particularly not many small investors were doing that. And when I was done with that little project, I realized that I had done something that was of use to other small investors, and as it turns out, to professional investors as well. And so I posted the information that I had and the models that I had on an evolving technology at that time called the internet. Remember, this was in the early 1990s. And one thing led to another. I began being contacted by journalists. I began writing books, and that's how I segued into writing about finance and history.
Let me ask this question, quote from your title of your book. Could you tell us why people go mad in groups? What things should individual investors keep in mind not to go mad in this market?
Well, you're asking a very basic question about human nature. Human beings are, to not be too cute about it, are the ape that imitates. Why do we imitate? Well, if you think about the migration of human beings into the New World, the Western Hemisphere, it took about 5,000 to 8,000 years for our ancestors on these two continents to travel across the Bering Strait, down through the wastes of the tundra and the Arctic, down to the Great Plains of the United States, all the way through South America to the tip of Tierra del Fuego. And along the way, we had to learn how to build kayaks and hunt bison and build poison blow darts. Now, none of those things are easy to do if you've never seen them done before. And so evolution favored a species that could learn by imitating. Not that you don't internalize, you're not born with those abilities. Mother Nature doesn't select with those abilities. What Mother Nature selects for is the ability to imitate. Now, that works very well in a state of nature. Unfortunately, it's poison in the field of finance, because if you're imitating what everybody else does, and remember, we're all programmed to do that, you will have your head handed to you. So that is why people go mad in groups, is because we imitate. That also gives you a clue as to how you avoid falling into that trap. The very most important thing that you have to realize is that if you are buying the same stocks and investment funds as all of your friends and everybody in your family, you're probably doing something wrong, okay? Mm-hmm. Because there are too many people chasing a given asset. You should be buying things that no one else wants to buy or are out of favor. So if everybody's investing in tech stocks, maybe you shouldn't. If everybody is investing in cryptocurrency, maybe you shouldn't. Now, the real question that you're asking is, how do you identify bubbles? How do you identify the madness? Right. And I've already given you one hint, which is that you should not be doing something that everyone else is doing. If every time you go to a party and everybody is talking about a given tech stock or a given crypto, you should probably stay away. If you get into a taxi or a ride share and your driver starts telling you about his adventures in cryptocurrency, that's a warning sign. Mm-hmm. The second thing that's the second sign of a bubble is related to that. Is when you see people who are otherwise untrained in finance all of a sudden deciding they're going to trade something. Right now, that's crypto. 15 years ago, it was real estate. At least in the United States, it was. That is a warning sign. The third warning sign is when a bit more subtle and is a bit harder to identify. But it's when, if you express skepticism about something, people just don't disagree with you. They get angry at you. Okay, why, if you tell someone that crypto is maybe not a great investment, why are they getting angry at you? Because they believe that that's their road to effortless wealth. And there are few things that anyone wants to hear less than you're not going to get wealthy after all, okay? And in fact, you're probably going to lose a lot of your money. And then there's a fourth sign, which is when people start making extreme predictions. You know, Bitcoin isn't just going to go to $25,000 or $30,000, it's going to go to $1 million. And when you see those kinds of extreme predictions, that's also a warning sign.
Okay. To me, it also sounds like meme stock is also danger. Do you think so?
It seems that way to me. Yeah, these are companies that are, frankly, they're dying. And the reason why meme stocks became so popular is because rational investors, and I put that in quotes, rational investors, short sellers identified all these stocks, not just GameStop, but also AMC, BlackBerry, companies that have a model that's not doing very well these days. And so short sellers accumulated short positions in them, and they were targets for what's called a short squeeze, which is probably something that most of your viewers know about. If there's too much short interest, then you can squeeze the short sellers. And so it wasn't just that GameStop got short squeezed. All these other companies that were doing very badly that had been identified by short sellers also got targeted as well through a crowdsourced sort of mechanism that went via a number of routes, but mainly Robinhood and Wall Street bets. And that's how that came off. That's not going to last forever either.
Your answers also can be some wise answer. So I have to thank you for that. And let me keep on that kind of question too. I'd like to ask how stock investors can find the bottom of the market. Furthermore, personally, I believe you would give a precious answer to this. How can investor avoid losing money in this market?
Well, the important thing to realize about investing is that from time to time, you're going to lose a lot of money in risky assets. Okay, risky assets have the highest returns. Stocks have the highest returns because from time to time, they lose a lot of money. And there's no way of predicting when that is going to happen. And the most important thing to remember about investing is your very long-term results. In the long term, how well you do is determined by how well you do in the worst 2 or 3% of the time. Okay, when you've seen your portfolio cut in half, when you've seen that you're down hundreds of thousands of dollars or hundreds of millions of won, and the important thing is that you don't lose your head. You keep on holding your assets, and maybe even you buy more risky assets, because the important thing to realize is how you feel then is going to be very different than how you feel now about the market. You're not going. Everybody thinks they're going to buy at the bottom. No one buys at the bottom because they feel so awful.
Right. I'll ask questions for Koreans specifically. Koreans have invested heavily in US tech stocks and focused on individual stock. That means Korean retail traders generally have invested far from index fund and love to high risk taking investment. Could you give advice to that Korean investors?
Well, the important thing to realize is that in almost every stock market around the world, value stocks do better over the very long term than growth stocks, because everybody knows about the growth stocks. Everybody knows about Apple and Intel and Tencent and whatever your favorite growth stock is, because they're in the news. And what happens is their prices get bid up. You're paying an enormous amount of money for a very small amount of earnings, relatively speaking. In the long term, you're better off buying a broadly based index. Now, the key thing you have to remember is whenever you buy or sell a stock, there is somebody on the other side of that trade. Okay. And the person on the other side of that trade is not some idiot who doesn't know that, Apple is not a great company. It's likely someone with an IQ of 160 who works 80 hours a week, who has actually run the numbers and looked very carefully at the spreadsheet and has decided that Apple is overvalued and wants to sell it to you because you're the patsy in that particular game. And the analogy that I like to use is I don't know if Koreans are big on tennis, but it's like playing tennis against an invisible partner, in which you don't realize that the other person on the other side of that net is Serena Williams.
Okay, thank you for your answer. And I also understand you prefer talk about investors' attitude and some psychology, but if you don't mind, do you have kind of watch list for US stock market? If so, could you share your lists on your top picks or something?
The question that we got asked all through a year ago and 2 years ago was, what are we doing about inflation? All right. Now, inflation turns out to be the biggest risk facing any investor, which people are now just starting to realize. People didn't really understand it for 30 or 40 years since the last bout of inflation that we had in the United States. And so how do you guard against inflation? Well, you keep your fixed income durations short. You don't buy long bonds because long bonds do badly when interest rates rise. You buy value stocks. Value stocks do better with inflation because their cash flows come up front, and so they get discounted less when the interest rate rises. And you own the companies of some commodities producers. 2 years ago, 1 year ago, the oil companies and the gold companies were basically being given away. That because everybody thought that their prices weren't going to go up. The prices of those commodities weren't going to go up. You buy straw hats in January. You don't buy them in July.
Thank you. And let's ask that things again. Like you wrote in this book, we might find a good example in the past market history to avoid risks that repeated in this day. Do you think recent stock market resembles 2008?
Well, in 2008, the stock market, the U.S. stock market, lost about 50% of its value. Outside of the United States, including, I believe, in Korea, it lost even more. Of course, Korean stock markets had their own unique bear market in the late 1990s, as you well know. And the most important thing for any investor to realize is that about once every year or two, stocks lose 10%. About once every 3 or 4 years, they lose 20 or 25%. And about once every 10 or 20 years, they lose half their value, 50% of their value. And it is not uncommon for stocks to lose in some markets a lot more than that. The US market, for example, lost almost 90% of its stock price between 1929 and 1932. That can happen. And the most important thing for any investor to realize is to have plenty of liquid reserves around for when that happens. You don't get a lot of return by owning safe assets, government bonds, but nonetheless, in a sense, they are still the highest performing asset class or the most valuable asset class in your portfolio, because they enable you to sleep at night when things really go wrong and hold on to the rest of your portfolio. If 100% of your stocks, 100% of your portfolio is in stocks, and stocks go down by 60%, you're probably going to sell in panic, okay? If you have a nice balanced portfolio and a big pile of government assets, you'll sleep well, and you may even use some of those government assets to buy more stocks or buy the apartment off of your neighbor who is invested too heavily in stocks and has to sell.
And you are also known as a founder of investment management service advisor group, Efficient Frontier Advisors. So I am curious about your strategy against recent market.
Well, I basically just told you what it was over the past 15 or 20 minutes, which is we invest in value stocks. We are very broadly diversified. We own stocks all over the world, through our vehicles, tens of thousands of names. We do have a little bit of commodities producing companies. And we also keep our bond maturities very short, which didn't work out well from, let's say, 10 or 15 years ago until 2 years ago. But over the past year or so, it has enabled us and our clients to sleep very well. And that's the most important thing. What I like to say about investing is that it's half math, half analysis, but it's also half Shakespeare. That is to say, managing your emotions. Shakespeare is about the folly of the human condition and human emotions. That's what he wrote about. And so you have to be able to manage both. You have to be able to do the math, and you also have to be able to manage your own emotions as well, which is the hardest part. The biggest enemy you have in the market is not risk in the market. It's the face that stares back at you in the mirror.
Okay. I also wonder your point of view about the cryptocurrencies. I think you mentioned a little bit before, but I have to ask again. I watched past interviews you did. I felt like you have warned danger of Bitcoin. And do you think investing in crypto looks like investing in tulip back in the days? I mean, back in the last centuries.
It sure looks that way to me. This is a very complex issue, and it's a very complex, a difficult prediction to make. You can easily be wrong. But if I had to bet one way or the other, I would bet against crypto. Now, the important thing about investing in cryptocurrency is to realize that it's what in English is known as a portmanteau, which is a very fancy word for one word that's made actually of two words. So it's cryptocurrency. Okay. Mm-hmm. And most important part of those two words is the currency part. Who in their right mind vests a large part of their portfolio in dollars or yen or euros or yuan? Okay. No one in the right mind would put a large amount of their money into just those things. Well, cryptocurrency is the same thing. It's a currency, and not a terribly stable one either. So why would you want to invest in currency for a large part of your portfolio? The only reason to invest in the currency is if you think there's someone out there who's more foolish than you who will take it off your hands at a higher price. That's never a good investment strategy. It's what in English is called the greater fool theory.
Okay. And I also wonder about the currencies, about the dollar. Do you think the dollar can be stronger or can be moved to another position compared with these trends?
I'm a big believer in what's called the Big Mac Index, okay, which is how much does a Big Mac hamburger cost in New York versus Seoul versus Paris. And what that tells you is that you can buy a Big Mac now cheaper in New York than you can in Seoul or Paris or Sydney or Singapore, okay? It tells you that the US dollar then is overvalued and all these other currencies are undervalued. When currencies reach a top, everybody is talking about reasons why it should go higher. That to me is a sign of a top. I'm going to Europe in a couple of weeks and I can't wait. It's been a long time since I've seen the US dollar buy that much abroad. So that's usually a sign that the currency is overvalued. The US dollar is overvalued.
지금까지 윌리엄 번스타인과 함께 시장을 보는 눈 그리고 투자 심리가 움직이는 방향성에 대해 이야기를 나눴습니다. 개인적으로도 귀중한 시간이 되었습니다. 오늘 시간은 여기까지 하겠습니다. 시청해주신 여러분 감사합니다.